UnitedHealth jumped 10.3% today after the company raised its full-year 2026 earnings per share guidance above street estimates. Disclosed in this morning's 8K filing covering results of operations. That single update was enough to force a rapid repricing across a stock that had been pricing in far more conservative assumptions. A double-digit move on a guidance revision tells you the gap between what analysts were modeling and what management is now guiding was not small. Here is what makes a mid-year guidance raise in managed care structurally different from what you see in technology or industrials. Most large-cap companies are cautious about revising guidance halfway through the year because their forward visibility is limited. Too many variables are still in play. Health insurers operate on a different information curve. By July, UnitedHealth has 6 months of actual claims data flowing through its systems across tens of millions of members. That is not a forecast extrapolated from a few early data points. It is actuarial experience built on real utilization patterns, real cost trends, and real enrollment figures. When management raises guidance at this point in the calendar, they are calibrating against H1 data they have already lived through, not modeling what might happen. Health insurance economics come down to a single gap: the difference between what you collect in premiums and what you pay out in medical claims. When medical costs run below what you priced for, the excess flows directly into operating income. For UnitedHealth to raise full-year guidance in July, at least one input in that model improved meaningfully. Either claims came in lighter than modeled in the first half, meaning medical utilization ran below initial expectations, or enrollment held better than anticipated, meaning more premium-paying members than the model assumed. Or pricing for the back half of the year is tracking more favorably than the street had projected. The company has not broken out which driver dominated, but the scale of today's stock reaction suggests it was not a close call. The phrase above street estimates is doing a lot of work in this story. Sell-side analysts build their models from public disclosures, Medicare Advantage pricing filings, and Medicaid reimbursement rate data. When management raises above that consensus, it means one of two things. Either H1 actuals came in better than what analysts could reconstruct from outside information, or management is carrying meaningfully higher confidence in H2 assumptions than the consensus model allowed. The 10.3% stock reaction is itself a data point on magnitude. A 1 or 2% guidance nudge on a stock this size moves it 1 or 2%, not 10. The market's math implies the raise was substantive, not a rounding adjustment. One piece of managed care economics that consistently gets underweighted in earnings coverage: investment income. UnitedHealth collects premiums at the start of each month and pays claims on a lag, sometimes weeks, sometimes longer. That timing gap creates a persistent cash balance sitting in fixed income. With the 10-year Treasury yield at 4.58% as of July 14th, per Federal Reserve data, and the Fed funds rate at 3.63%, investment income is a structurally higher contributor to results than it was during the near-zero rate environment of 2021 and 2022. It is not the headline driver of today's move, but it is a real, recurring tailwind that does not require any improvement in medical cost trends to persist. Healthcare was being described as a haven in today's session, with chip makers and technology names selling off sharply. That framing has real substance when the underlying earnings story supports it, and today it does. Managed care companies generate contractual, recurring premium revenue that does not depend on GDP growth or consumer discretionary spending cycles. When growth names face macro headwinds, capital tends to rotate toward businesses with earnings predictability. A mid-year guidance raise from the largest managed care operator in the country is a concrete confirmation of that predictability. Not a sentiment call, not a defensive posture, but an actual update to a numbered range that analysts have to revise their models around. 3 metrics will determine whether today's raised guidance holds through year-end. First, the medical loss ratio in Q3. Any deterioration in claims trends from the H1 baseline would pressure the new range from below. Second, enrollment stability in Medicare Advantage, where competitive pricing from rivals has been an ongoing variable across the sector. Third, policy developments affecting Medicaid reimbursement rates, which are set at the state level on rolling schedules and can shift the government segment's contribution materially. The 8K filed this morning sets the bar. Everything between now and the Q3 report either confirms or challenges it. Today's move is the market's first read on the new numbers. Q3 delivery is the real answer.